Hello and welcome to the fourth quarter CCR Wealth Management investment discussion and webcast. I'm Mark Palmerino, a partner with CCR Wealth Management, and I'm here with our Chief Investment Officer, John Maher. We're coming to you the third day of the fourth quarter, 2019, and as of today, the market has been down 850 points in the first 2 days. We're here going to talk about some topics that have been on the minds of our investors and our clients, and John and I are going to have a discussion and go over them. So John, first of all, in any market, commodities are a good diversifier for a portfolio. And over the course of our tenure here and during our careers, we've used gold, oil, silver, miscellaneous commodities to diversify portfolios. Is there a specific time where that makes more sense than others, or is it a universal discussion that should be had?
It's a good question, Mark, and I would just kind of home in on the term diversifier, because that's really at the heart of what we do. And what we do is try to build what we call durable portfolios. And durable portfolios by their nature are diversified portfolios. Now, you've been doing this as long as I have, and it seems that there's always a group of investors that we work with that don't want a diversified portfolio. Certainly not when the S&P's on a tear.
Right. They only want the things that are doing great.
When there's less uncertainty in the market, they're hoping to get all the market return. And then, the flip side is also true. When the market is in a correction the way it was a year ago, they're looking for some sort of an absolute positive rate of return that has no bearing on what's going on in the market. So the truth of the matter is diversification is the key. It always has been. And we talk about diversification, we're talking about really two things. Number one is a dispersion among asset classes. All right, so stocks are an asset class, bonds are an asset class, and there are other asset classes. We'll use commodities as an example. The second thing that we concern ourselves as far as diversification is concerned is measuring diversification. It is a measurable thing, and it should be measured. You should have an understanding of to what degree assets are moving with each other or in opposite directions. So we do that using correlation. Now, to an extent, all stocks move together, right? I mean, when the markets are up, most stocks are moving up. When the markets go down, most stocks are moving down. There is variation within the market, and just to get a recent example, while most of the market has been moving down over the last couple of weeks, as you mentioned, or last couple of days, as you mentioned, you're going to find, say, utility stocks that are moving down somewhat less than the rest of the market.
Sure.
The same is true of the bond market, right? All bonds are interest rate sensitive, but to different degrees, and some have a lot of sensitivity to other factors such as economic traits, credit spreads, and that sort of thing. The truth of the matter is, though, we use another asset class like commodities because there is, as I said, while there's variation within the stocks and bonds, in truth, credit, but when you build a diversified portfolio, you're going to have a lot of credit in that portfolio, in your bonds. And credit bonds tend to be more highly correlated with equities. Sure. I would use an example, I've used it frequently internally here, and that is high yield bonds. High yield bonds tend to have a very high correlation with equities. So we pay attention to correlations among asset classes, we pay attention to correlations within asset classes, but adding another asset class, and commodities is an example, that has very little correlation with either stocks or bonds. I would give you a more recent example, and everybody's, is it a great time to get into commodities, or is commodities maybe, or another asset class like commodities, something you should have in the portfolio at all times? I would fall into the school of thought that says, having a modest position in commodities regardless is a positive diversifier for a portfolio. Therefore, you're going to have a more durable portfolio. Commodities as an asset class is made up of a number of different things. And you mentioned silver and gold and some of the things that way back in the past we've fiddled with, so to speak, when there was a real secular bull market in them. But commodities is much more than that. Commodities includes energy, right? Oil, natural gas, Commodities includes all agriculture. It includes all livestock. Commodities includes all metals, right? Non-ferrous metal, base metals, and they all have sensitivity to different things. More recently, we saw tensions in the Persian Gulf cause oil prices to spike, right? Oil prices spiked, energy prices spiked, when most of the rest of the market was moving sideways or going down based on economic fears. And much of that spike remains with us in the market. There are other commodities such as agriculture and livestock that are sensitive to weather. They're sensitive to blights. They're sensitive to things that are really unpredictable. Bumper crops, for example. Metals sensitive to global economics, maybe more highly correlated with economics, and construction demand throughout the world.
And trade, the whole trade debate too has moved the prices of various commodities based on how the discussion
It certainly
has been
has.
going.
Trade debate has. We can look at the trade debate. We also look at more recent inflation figures. I mean,
Yeah, right.
inflation is not. I'm not here to make a case about it. You know that inflation is flying high, but you know we have core inflation currently at hovering around a 10-year high. I made the note about 18 months ago, and I was really quoting, Jeffrey Gundlach, but that's saying there has really not been a recession, and we're not calling for a recession, but there really has not been an end of a market cycle without having inflation or inflationary pressures move higher, and so when you look at commodities, we can say that certainly with non-perishable commodities that can be stored, there is a high correlation with inflation that simply you don't get with most fixed income investments, and simply gives you another element of diversification in a portfolio.